back to the channel on the college process. Once again, my name is Ed from Principia Prep, and today we're going to be going over the 6 worst ways to pay for college. But before we start, if you are new to the channel and are looking for additional college content, please hit the subscription button down below. It will notify you of new videos when they do come out. As well as if you do enjoy today's video, please leave us a comment and a like. It does help the channel. That being said, let's jump right into today's video. The 6 worst ways to pay for college. Now, in 20 plus years of myself being a college advisor, I've seen many unique and many creative ways that parents have come up with to pay for the college cost. And some of the 6 ways are ways that some parents have utilized and are continuing to utilize to help pay for college. But for me, they're unfortunately probably the worst ways to go when it comes to paying for college. So for me, the 6 worst ways of paying for college, right off the bat, number 1 is credit card, followed by taking money out of your retirement. And the third line is over borrowing from student loans, with the 4th in line being borrowing from home equity. The 5th worst way of paying is selling stock or exercising options. And the 6th and worst way, in my opinion, to pay for college is to utilize life insurance policy. Now I'm going to go individually through all 6 of these and explain to you why I think these are the 6 worst ways to pay for college. Now the first way, good, bad, or indifferent, most of us have gotten basically comfortable with paying with everything with a credit card, which is understandable. But from my perspective, this is not the best place to go, is paying college with a credit card, unless you have a game plan in place to pay off that credit card quickly or within the month, so you don't have the interest building on. And it is also okay if the school is not charging a convenience fee. Now, most schools unfortunately do charge a convenience fee if you are looking to use a credit card. And typically the convenience fee is typically anywhere from 2 to 4%. So based on this situation, let's just say that your fall semester you're looking to pay with a credit card, and let's say you have a $10,000 fall bill. Well, essentially, if you add the convenience fee to that, the school charges one, your bill just went up from $10,000 to $10,400. So you just increase your bill right off the bat just based on the convenience fee. And the reason the credit card is a bad idea in my mind, if you're paying the minimum, you're going to be paying tens of thousands of dollars in interest throughout the time frame you're looking to pay off that credit card. If you're looking to use this strategy just for the first semester bill that you just got here in the summer, then you have to think about it from this perspective. This $10,000 bill, which went up to $10,400 because of the convenience fee, if you do that each semester, you're talking about in some cases either increasing the college cost by 50 to 100%, if not more. So something you really want to try to avoid as much as possible. Now let's go over the second worst way to pay for college, which is borrowing from retirement. Now for me, borrowing from retirement, a lot of parents bring it up because of the fact that we have money set aside in 401ks, IRAs, Roths, etc. Now, for me, the difficult part from this is right off the bat, I know I can borrow from a lot of different entities, Parent Plus loans, state loans, private loans, etc., to help fund the college cost. So one of the negatives for me, and many parents talk about this as well, is that you can't borrow for retirement. So obviously taking money out that could be working for you to pay for college when you can borrow from a loan, it's not a good way to go. That's one of the reasons I don't like it right off the bat. And then of course, for parents that are new to this video and new to our channel, I, by the way, speak at around 70 high schools, and I see anywhere from 3,000 to 4,000, some cases 5,000 families a year. So for me, utilizing retirement is a rare case where it actually makes sense, to be honest with you. I have seen it where it does make sense, but it's a handful of cases, and I've seen hundreds of thousands of families where it doesn't make any sense at all, by the way. Because in addition to obviously losing the value of that asset growing by leaving it there and not borrowing from retirement, one of the other things that a lot of parents always say to me, Ed, well, what about the fact that we can borrow from our Roth IRA to pay for a certain amount of educational expenses and not hit with a 10% penalty right off the bat? And my answer to that is very simple. You still are getting penalized technically twice by taking money out of retirement to pay for education. And this is what I mean by you're being basically penalized twice. Right off the bat, you will be taxed on that money you take out. So even though you're not getting a 10% penalty, it will show up as income on your tax return. So number 1, you're being taxed by the tax man. And number 2 penalty, the second tax you technically have, is the fact that the college is going to tax you as well. Because if your income goes up because you borrowed from retirement, then the next upcoming academic year, they're going to see that on your FAFSA form, which means your ability to pay is going to also increase because technically your income increased. So if that university is offering you grant money, that income increase could potentially lose your grant money or lose a portion of the grant money they're already giving you. Let me give you an example. Let's say the college your student is looking to go to costs $50,000 a year. Let's say you fill out all the financial aid forms, and the financial aid forms say that you can essentially pay $30,000 towards the cost of college. Let's say you decide, I'm going to take that $30,000 out of retirement. Guess what? Your income just went up $30,000. So essentially what you technically did, because in the world of financial aid, when it comes to income, they look at the parent's ability to pay for college based on the income at a rate of typically 20%. So let's say your college was very generous. The school cost 50, you could pay 30. Then next year comes around, let's just use all the same numbers, even though college has increased in price and so on and so forth. But your income basically indicated to them that now you can pay an extra $6,000 towards the cost of college, because 20% of $30,000 is $6,000, which means your ability to pay went from $30,000 to $36,000. So that college cost $50,000 before, and they gave you $20,000 of grant money because you had $20,000 of space there. Guess what? That grant will now shrink to $14,000. And this is just considering if the college was generous enough to give you the $20,000. Let's say the college didn't give you much more than $4,000 or $5,000 in grant money because they weren't able to give you a whole 100% of the need you had. Guess what? That $4,000 or $5,000 grant you had before is now gone, because your increase of $6,000 extra that you can pay every year has now eliminated your grant money. So you must think about what you're doing when you're borrowing retirement, because right off the bat, the tax guy is going to hit you. Second, the financial aid person is going to tax you on it. And third, and worst case scenario, if you do have the 10% penalty, you're technically getting dinged 3 times: the tax man, the 10%, and the loss of financial aid eligibility. This is why I typically do not like borrowing against retirement, because it's going to affect future financial aid opportunities. Let's talk about the third worst way to pay for college. Now, this is basically over borrowing a student loan. And this is what I mean by over borrowing a student loan. Now, the first thing you need to understand is I'm always an advocate for looking for avenues other than student loans to pay for college. No matter what it is, scholarships, grants, work programs, etc., I'm always looking for ways to pay for the college cost without borrowing. Borrowing is typically the last option I tell parents to look to go to. However, in the environment we all find ourselves in, and the cost of colleges nowadays, almost everyone is essentially borrowing towards the cost of college. It's just an unfortunate evil we all have to deal with. That being said, I'm okay with students borrowing from college as long as it makes sense. And this is what I mean by makes sense. If your student's going to be borrowing, let's say $150,000 in debt over their 4-year time frame in the college, I'm okay with borrowing all $150,000 as long as the student's going into a career where the median income is, let's say, $80,000 to $100,000 over a few years. So I know that student can afford to pay those monthly bills and maybe reduce the debt down very quickly and get out of that debt situation. I'm not okay if a student's going to be making median income based on their career path $30,000, $40,000 a year and taking out $150,000. Typically in this scenario, I typically tell the student and the family, I'd be looking at a different major or I'd be looking at a different university, because of the amount of debt you're looking to take on. It's going to take over your life for over 10 years plus in some cases. So probably not the good way to go. But once again, I am an advocate for loans as long as they make sense and the family has a game plan in place to pay them off. That being said, let me give an example of over borrowing a college loan. First off, the first thing you need to understand is every college has technically 2 college costs to them. The 2 college costs are direct cost and indirect cost. Direct cost is what you're paying directly to that college: the tuition, the room and board, the fees for that college. The indirect costs are books, transportation, laptop, this kind of stuff. Indirect costs you have that you don't pay directly to the college. Now, every university will allow you to borrow up to their cost of attendance. Now, if you don't know what cost of attendance is, I suggest you watch this video down below. I have in the description. It goes over what the cost of attendance is, how it works, so on and so forth, so you're better informed about what I'm talking about here. I go down in the link. If you want to just press pause on this video, open up another tab, watch that video, come back, better able to understand what I'm talking about here. Now, when it comes to most colleges, their cost of attendance, the direct and indirect cost, it allows the students in many cases to receive a refund check throughout the academic year of anything from $5,000 to $8,000 over the academic course that year, which means, technically speaking, your student can essentially take out the max amount of loan possible out there. Let's say the school once again costs $50,000 direct cost to the school, but the school lets you borrow up to $58,000 and they refund you back to $8,000, which you can use for room, board, books, etc. Now, I'm fine with taking that refund check, that $6,000, $7,000, $8,000, and utilizing for the books or transportation or things you need for the college, maybe supplies, a laptop, etc. I'm okay with that. Now, what I'm not okay with, and what does happen unfortunately sometimes, is the family takes the refund check and all of a sudden the student's going on spring break, or they use the refund check to put a down payment on a car, or they use it for just some expense that's really not within the educational framework of what that money should be used for. The reality is you don't want to do this for a bunch of reasons. right off the bat, let's just say, let me give you an example again, that the student takes out the whole amount they need, the whole $58,000. Same example here we're using again. And they get the $8,000 refund checks in the fall and spring, $4,000 fall, $4,000 spring. And you take the whole $8,000 and spend it on whatever, but it's not educational purposes. If you do that every single year, every year your student goes on spring break, every year they use the money up for something they shouldn't have, that $8,000 will basically be $36,000 in debt, additional loan debt you'll have to be paying back later on. If you look at it from the perspective of the standard 10-year student loan repayment at a 6% interest rate, your student will be paying almost $50,000 for that additional loan you took out, in addition to the loan funds you use to pay for college. There's no spring break, there's no car, there's nothing you could possibly do with that money that's worth this additional debt. Because you have to remember, if you overborrow and want that refund to do anything else, it still has to be paid back, in addition to the loan funds you took out to pay for the college itself. Now, the fourth way of paying for college for me is borrowing from home equity, or basically taking a home equity line out on your house to be able to pay for college. Now, I know everyone's going to be saying, well, Ed, interest rates are at low rates, or I can get great terms. Why would I not borrow from my home equity? And for me, it's very simple. I never want to put my house on the line for anything that has no actual value. You might be thinking, what are you talking about? Of course, the college education has value. And it does, but this is the way I look at it. If you borrow a home equity line and something goes wrong and you can't pay back that home equity line, unfortunately, they're going to take your house. It's just the reality of how the loans work when it comes to housing. If you guys were to take out a student loan instead and your student couldn't pay that back, the reality is that paper, that degree, has zero value other than to your student. There is no actual asset that the loan company, from the student loan company, can come and take from you. So if you can't pay back the student loan, guess what? Only thing that happens is your credit gets shot, or the student's credit gets shot. If you can't pay back the home equity line, they're going to take your house. So for me, I'm never looking to put the home on the line, especially somewhere I live, to pay for the college education. Now, there are some families where a second property is involved, and that's a different way to go. So if you lose a second property, maybe it doesn't matter to you. But the reality is, I'm never looking to put the home on the line. Now, the fifth worst way to pay for college education is selling stock or exercising your options. Now, I have seen this done by a lot of families, and I am okay with it as long as this money, the stocks, the options, so on and so forth, would put in place as kind of your version of 529 plans. So maybe you didn't know where the student wanted to go, so you wanted to keep yourself more liquid rather than being locked into a 529, then I'm perfectly fine with using the stocks and the options and everything else to pay for the student's college education. But what you need to realize, though, is we go back to the double taxation, essentially. Once you exercise that option, once you get the capital gains on that stock, same thing happens, by the way, for real estate. If you're selling a second property or looking to sell your home to pay for college. Any increase in your income, which will come from the capital gains, which will increase your income, will automatically get you taxed twice. One from the IRS and one from the financial aid office. Always look at what your effects will be if you do take a capital gain hit on the financial aid end. Is there potential of losing grant money? And the last of the 6 worst ways to pay for college, in my opinion, is using life insurance. Now, some of you might be thinking, well, Ed, we've been told if we get a life insurance policy, the cash value in that life insurance doesn't show up on financial aid forms. So it's our way of shielding that from the financial aid office. And that is actually half true, to be honest with you. If your school uses a CSS profile form, the College Scholarship Search form, in addition to the FAFSA form, sorry to be the guy who spoils this for you, but the colleges on the CSS profile are asking about cash value life insurance. So unfortunately, if it's a CSS profile school, they're more likely going to ask you, do you have cash value life insurance? Also, if you're looking to basically utilize a life insurance policy as a way of hiding your assets, the reality is when it comes to college financial aid, the grant money specifically, the free money, most schools are not looking at your assets as a big portion of what you can pay to college. What they're really looking at is your income. So let's just use an example. If you have, let's say, a $250,000 income, based on typically the 20% or so they look at for your income, you're already looking to pay $50,000 just based on your income. So right off the bat, if this is your plan to use the life insurance to kind of shield that asset or utilize it to help pay for college in some way, if you're at $250,000, number one, you have to find a college that costs over $50,000 to even begin this process. So let's just say, as an example, the college is $60,000 a year and your income's already indicating you can pay $50,000 a year towards the cost of college. You only have $10,000 of financial aid space, which you really don't even have, because once you fill out the FAFSA form, every school is going to offer your student a $5,500 federal loan, which then shrinks your space to $4,500. So if you only have $4,500 of financial aid space, and let's say you put a couple $100,000 in the life insurance just to hide it, that hundreds of thousands of dollars you hid really has no impact on anything whatsoever because it's your income that's affecting you the most, unfortunately. A lot of these policies have surrender charges, management fees, commission fees, and so on and so forth that will eat away at your assets. So the reality is, unless you were doing this decades ago, a life insurance policy is probably not going to help you. In my 20 plus years of doing this, I don't think I've seen a single case. And remember, I've dealt with hundreds of thousands of families where a life insurance policy made sense. Now, if you're looking to get life insurance, get it for what it was designated for, life insurance. So essentially, for me, those are the 6 worst ways to pay for college. Number 1, credit cards. Number 2, borrowing from retirement. Number 3, over borrowing from the student loans. Number 4, home equity. Number 5, selling stocks or equities and or property. And of course, the last one, life insurance. Now, if you have a creative way to pay for college and want me to discuss it, or if you want to ask any questions, please leave comments down below. And if you enjoyed today's video, please leave us a like. It does help the channel. Other than that, I'm Ed from Principia Prep. On the screen, you see our contact information. If you have any questions or need help in the process, please reach out. Other than that, thank you for watching today's video.